Well, in order to do that, right, the analysis of EPS, we will usually start first with the learning outcome statement. Here the LOS says now, distinguish between dilutive and anti-dilutive securities and describe the implications of each for the EPS calculation. Well, first of all, if you have to distinguish between securities are dilutive and anti-dilutive, then the meaning is here, if we include the security which will lower the EPS figure, then such a security is known as to be dilutive. Otherwise, if we include a security in the EPS calculation and the EPS goes up, right, instead of going down, then this security would be anti-dilutive. So that's about this LOS, which says about which requires to know about the differences between dilutive and anti-dilutive securities. Then if you move on perhaps to slide 5 very quickly, you see now the next LOS, which requires from you then at the exam to calculate and interpret a company's EPS for a simple capital structure and describe how EPS is calculated for a simple capital structure. And then later on, you will see then on other slides then the same LOS requiring from you then to calculate diluted EPS then for a complex capital structure. Well, let's quickly take an overview about the calculation of EPS. Well, I start this overview as follows here. So we have, if you're looking at the EPS calculation, then we have to distinguish between basic EPS and diluted EPS. So we have basic EPS to be calculated and diluted EPS. If I just write down the equation for basic EPS, then the equation for basic EPS looks as follows. We have to take in the numerator the income available to the common shareholders. That's net income minus the dividend payments to the preferred stockholders. So I just take the income available to the common shareholders. That's net income. And from net income, we have to deduct then the dividend payments to the preferred stockholders. So minus, I just writing down here, preferred dividends. The meaning is here the dividend payments to the preferred stockholders. And that's divided then by the weighted average number of common shares outstanding. So that's how basic EPS then will be calculated. So we have to divide the income available to the common shareholders by the weighted average number of common shares outstanding. So weighted average number of common shares outstanding. So that's the equation used then to calculate basic EPS. Now, I do not write down the equation for diluted EPS because that's a quite complicated one, especially if you consider that a set of potentially dilutive securities, then the equation will become quite complicated. So for this reason, not writing down this equation about diluted EPS, but I will show it then later on how this equation looks like. Well, now you have to understand if the firm has a simple capital structure. A simple capital structure, that's a capital structure which is defined without any potentially dilutive securities. So if this is the case, if the firm does not have any securities that are potentially dilutive, then the firm has a so-called simple capital structure. And if this is the case, then the firm must disclose in its financial statements only basic EPS and not diluted EPS. On the other hand, if the firm has a complex capital structure, so-called complex capital structure, then such a capital structure includes potentially dilutive securities, such as, for example, convertible bonds. So that's one of the potentially dilutive securities. This are included in the curriculum reading, so convertible bonds. A convertible bond is a bond that can be converted into common shares or into shares of common stock of the firm. That's a convertible bond. And if this occurs, then the EPS figure can either go up or can go down. If the EPS figure goes down, then we know that the convertible bond is dilutive. Then we have also further potentially dilutive securities, such as a convertible preferred stock. A convertible preferred stock can also be converted, just write for PS, stands then for preferred stocks. That's then a preferred stock that can be converted into common stocks of the firm. And if this occurs, then again, the EPS figure can either go up or can go down. Or in addition to that, the firm can also issue warrants, for example. And please note here, the warrants issued by a firm, these are warrants which are issued together with the debt, with bonds. And after the issuance then of the bonds with the warrants will be detached from the bonds and traded then separately in the market. So these warrants are call options on the stocks of the firm, on the common stocks of the firm, and therefore if they are exercised, then it will also have an impact on the EPS figure. So that's then about the warrants here. Do not confuse the warrants in the capital structure of a firm with the warrants that are sold then by investment banks. These are not these warrants that we're looking at, right? These are just warrants issued then by a corporation and not warrants sold by an investment bank that you find then in the newspapers, for example, in the NZZ. Okay. Then, if the firm has a complex capital structure, then in accordance to IFRS and US GAAP, the firm must disclose, in addition to basic EPS, also diluted EPS in its financial statements. So if you like, that's a big picture, first of all, to understand the difference between basic EPS and diluted EPS. And if the firm has a simple capital structure, that's a capital structure without any potentially dilutive securities, so with any convertible bonds, any convertible preferred stocks, and any warrants, then the firm must only disclose in its financial statements basic EPS. Whereas on the other hand, if the firm has a complex capital structure, that means a capital structure that includes potentially dilutive securities such as convertible bonds, convertible preferred stocks, and warrants, then in addition to basic EPS, the firm must also disclose diluted EPS. Well, that's about this big picture here before we continue now with our LOS that requires from you at the exam to calculate then basic EPS for a simple capital structure. See now in this learning outcome statement included is an active command word that requires from you to calculate in this example then, or for this LOS then, basic EPS. Well, let's take an example now to calculate basic EPS. On slide 8, you will find an exam type question. That's a level 1 exam type question here for those of you who are seeing now the first time how a CFA question looks like. An analyst has gathered the following information about the company. So preferred stock dividends of $350,000 were paid for the year. Then we know the capital structure only includes common stock and preferred stock. It does not include any potentially dilutive securities such as convertible bonds, convertible preferred stocks, and warrants. We know as well that the net income for the year 2009 was $1.35 million. We know common stock dividends of $450,000 were paid for the year. We know as well that 240,000 shares of common stock were outstanding on 1st of January 2009. The fiscal year end is December 2009, and we know that on 1st of June 2009, the company has issued 90,000 new shares of common stock. Now we have to calculate basic EPS for the year 2009. Well, in order to calculate basic EPS, we have to write down the equation, or we know the equation already from our previous big picture. So we have to take the income available to the common shareholders. That's net income minus the dividend payments to the preferred stockholders. So we know that net income, we'll find this information in the third bullet point, is $1.35 million. So we take $1.35 million for the net income. And from that, we have to deduct now the dividend payments to the preferred stockholders. And we know from the first bullet point that preferred stock dividends are $350,000. So that gives them income available to common shareholders of $1 million. And this income available to common shareholders must be divided now by the weighted average number of common shares outstanding. That's calculated as follows. So the weighted average number of common shares outstanding, or the denominator of the basic EPS equation, we have to take the common shares outstanding on 1st of January 2009. We have 240,000 common shares outstanding. So I take 240,000 common shares outstanding on 1st of January. And now to calculate on average how many common shares are outstanding during the entire year, we have to multiply the 240,000 shares with 12 months, and afterwards we have to divide that by 12 months. So that's then how we can calculate on average how many shares were outstanding during the year. So therefore, 240,000 shares were outstanding during the year. Then we know the company has issued 90,000 new shares of common stock on 1st of June. So we have to add now 90,000 shares. And the 90,000 shares are multiplied now by how many months? So 7 months. So we have from the month 1st of June until the end of the year. That totals then to 7 months. So on average outstanding are 90,000 shares times 7 months divided by 12 months. So the 90,000 shares issued on 1st of June 2009 are on average outstanding over the entire year 2009 by a ratio of 7 divided by 12. Do you see that? That's how we can calculate the weighted average number of common shares outstanding. Then you can plug the figures in your calculator, and if you do that, you should come up then with a basic EPS figure of $3.42. So that means that the correct answer then will be answer B. So that's how the calculation looks like for basic EPS. Is this okay for all of you so far? Important here is to know for the level 1 exam, the month count is taken to calculate the weighted average number of common shares outstanding, and not the day count, just our week count, for example. But instead you calculate the denominator of the basic EPS equation using months. Then you also have to know how to include any stock dividends or stock splits in the basic EPS equation. And you have to understand now that under IFRS and US GAAP, you have to retroactively restate the figures in the denominator of the basic EPS equation to include now or to account for any stock dividends and or stock splits. So let's have a look how we have to make the adjustment in the denominator of the basic EPS equation for a stock dividend in this example. In order to calculate EPS, an analyst has gathered the following information. So 3,000 shares of common stock were outstanding on 1st of January. Then we know that an issue of 1,000 new shares of common stock took place on 1st of February. Then we have a stock dividend of 20% that took place on 1st of May. Then a repurchase of 400 shares of common stock on 1st of August. And then an issue of 300 new shares of common stock on 1st of September. And now we have to calculate the denominator of the basic EPS, that means the weighted average number of common shares outstanding. Well, in order to do the calculation, we have to start first with the 3,000 shares of common stock outstanding on 1st of January. So we have 3,000, and we multiply that with 12 months, and after that we have to divide it by 12 months. So on average outstanding are 3,000 common shares during the year. Then we know that the firm has issued 1,000 new shares of common stock on 1st of February. So we are adding to the 3,000 times 12 months the 1,000 shares. And then from 1st of February until the end of the year, we have 11 months, so times 11. Then we know that a stock dividend of 20% took place on 1st of May. Now, who is entitled to receive a stock dividend? Well, those shareholders who hold the 3,000 shares on 1st of January, right, and those shareholders who have purchased the 1,000 new shares of common stock on 1st of February. That means those who have the 3,000 shares on 1st of January, they will receive a stock dividend of 20%. So that means they will receive 600 common shares of the stock as a dividend. And those who hold the 1,000, those who have purchased the 1,000 shares of common stock on 1st of February, they will receive then as a dividend 200 shares of the common stock. And now, under IFRS and US GAAP, we are restating the figures. That means we are retroactively restating the figures. So we have to go back now to the 3,000 shares at the beginning of the year, and you have to multiply that with a restatement factor of 1.2. So that means after the stock dividends, right, the common shareholders will have then 3,600 shares, common shares. Then we have to restate the 1,000 shares purchased on 1st of February, again using the restatement factor of 1.2. so times 1.2. So that means after stock dividend, these shareholders will have then 1,200 common shares. It's okay? So how we are doing the calculation under US GAAP and IFRS for a stock dividend or a stock split will be that we have to retroactively restate the figures. Well, another way how to do the calculation, which will be much more logical than this calculation, would be the following one, but that's not US GAAP and not IFRS. So what you would do probably would be that you would take the 3,000 shares times 12 months, and then you would divide that by 12 months. Then we have the issue of new common shares on 1st of February, so plus 1,000 times 11 months. And now we know that the stock dividend took place on 1st of May, so we know 4,000 common shares are entitled to receive the stock dividend. You would multiply that with 20%, and then from 1st of May until the end of the year, we have 8 months, right? So times 8, and that would be then a logic calculation. Let's put it in this way, but that's neither US GAAP nor IFRS, so that's not how the calculation looks like, under the accounting standards. So the accounting standards requires then to retroactively restate the figures. That's important to know here. Yeah? Yeah.
Also, the stock dividend of the new issued shares is also diluted with the period.
Nothing to do with diluted, right? Yeah.
It also counts with only the period that this share outstanding for the year.
That's right. Yes, only for the. If you are accounting for a stock dividend, that takes place in the current year, right? So the 20% stock dividend applies then in our example to the 3,000 common shares on 1st of January and the 1,000 common shares on 1st of February.
And
Yeah?
it's not fine with this 11 divided by 12 with
Yes.
this 1.2.
Yes, you have to do that, right? Because those who have purchased the stocks on 1st of February, they're also entitled to receive then a stock dividend.
Yeah,
Yeah.
full amount.
The full amount, that's right,
It's
yes.
the same as the 3,000, right?
That's correct, yes.
Yeah, but then if you do this calculation, it's not the same anymore.
What do you mean with not the same, yes? So let's move on to the next bullet point. We have a repurchase of 400 shares of common stock on 1st of August. A repurchase of common stocks means now that the number of common shares outstanding will go down. Do you agree with that? So therefore, we have to deduct the 400 shares, and we know now from 1st of August until the end of the year, we have in total 5 months, so therefore times 5. And then we have an issue of 300 new shares of common stock on 1st of September. That means that the number of common shares outstanding will increase by 300, so plus 300. And now from the 1st of September until the end of the year, we have then 4 months, so times 4. If you plug the figures in your calculator, you should come up now with 4,633 common shares outstanding on average during the year. So that means that answer A will be the correct answer. So that's how to account for a stock dividend in the basic EPS equation. Then it could be, right, that you have a stock, so instead of a stock dividend, you have a stock split, for example. So if you take a stock split, then a stock split could be, let's say, 3-to-1. That's a stock split of 3-to-1. So that means if you have 1 share after the stock split, you would have 3 common shares. You agree with that? And now if the stock split took place, let's say on 1st of May, then the restatement factor to be taken would be 3 here instead of 1.2. So that means if you have 3,000 shares after the stock split of 3-to-1, you would have 9,000 shares. And the same restatement factor applies then for the 1,000 shares purchased on 1st of February. It's okay? That's then how to account for a stock split. It's also clear why you have stock splits in the market, because a stock is too heavy, right? If you have a too high stock price, then that would lower the liquidity of the stock in the market. And if this is the case, typically firms will then apply a stock split so that the stock price then after stock split will be lower, and that will increase then the liquidity of the stock in the market. That's the reason why firms are doing stock splits. Okay, then let's move on, right? And let's have a look at the LOS on slide 11. Here the LOS says, calculate and interpret a company's EPS for a complex capital structure. And you see in brackets now both basic and diluted EPS. So the concept that applies here is the following one that we have seen at the very, very beginning of our discussion here. That means if the firm has a complex capital structure, that means a capital structure that includes potentially dilutive securities such as convertible bonds, convertible preferred stocks, and warrants, then the firm must disclose, in addition to basic EPS, also diluted EPS in its financial statements. So that's what the LOS is about. Well, the LOS, you see that includes an active command word which says calculate. So you have to know how to calculate, in other words, diluted EPS. Well, the first step will be, as we have seen before, if the firm has a complex capital structure, the firm must first of all calculate and disclose basic EPS, and the second step will be then that the firm must calculate diluted EPS. That means incorporating then in the EPS equation the potentially dilutive securities. Let's take now the equation that I've mentioned before when we looked at the big picture together, which is a complicated one. You see now that's the equation for diluted EPS. If all our three potentially dilutive securities, that's a convertible bond, the convertible preferred stock, and the warrants are dilutive, how they must be included then in the EPS equation to calculate diluted EPS. Well, let's bring some light into this equation. We start first with basic EPS. If you have to calculate diluted EPS, then we have to start first with basic EPS. Basic EPS, as we have already discussed before, is calculated as follows. We take net income minus the dividend payments to the preferred stockholders. That gives then the income available to the common shareholders, and that's divided now by the weighted average number of common shares outstanding. Then we have to include our first potentially dilutive security, and that's now a convertible preferred stock. Well, the convertible preferred stock is included as follows in this equation. So you see that here, I just changed the marker here, so I take the green marker for the convertible preferred stock. So that's our convertible preferred stock. If the convertible preferred stock is dilutive, then we assume that at the beginning of the accounting period, the preferred stocks are converted into the common shares of the stock. Well, that's done then with using the if conversion method. That means if the convertible preferred stock is dilutive, then we have to assume that the conversion took place at the beginning of the period. That's known as the if conversion method. Just writing down here one if conversion method. So that means we have to assume then that the conversion took place at the beginning of the accounting period. For example, if the convertible preferred stocks can be converted into 200 common shares of the stock, let's assume that, right? Then in the denominator, we have to include it, we have to assume that the conversion took place at the beginning of the period. So that means you have to take the 200 common shares that are given now to the preferred stockholders are included now as of beginning of the period. That means we take the 200 shares and we multiply the 200 shares with 12 months over 12 months. That's the if conversion method. You see, 12 over 12 cancels out, and we are left then with 200. So the 200 common shares given to the preferred stockholders are included right in the denominator to calculate then diluted EPS. So the so-called if conversion method is used. That means if the convertible preferred stock is dilutive, that means if its inclusion will lower the EPS figure, then the convertible preferred stock is dilutive, and then we have to assume that the conversion took place at the beginning of the period. It's okay for all of you. It doesn't matter whether the preferred stocks are converted or not. Yeah, these are accounting standards here. So that means if the convertible preferred stock will lead to a lower EPS figure, then we have to assume conversion, because then the convertible preferred stock is dilutive. Then what else do we have to include here in the diluted EPS figure is the numerator here. So that means the income available to the common shareholders will increase if the convertible preferred stock is diluted, right, is dilutive, and it's included in the diluted EPS equation. And that means you have to add back in the numerator then the dividend payments to the preferred stockholders. Does it make sense so far? Then the second potentially dilutive security, which is included in the curriculum readings, that's now the convertible bond. If you're looking at convertible bonds, then I can take here this marker here to show you the inclusion of the convertible bond. And first of all, you have to know that with the convertible bond, if it is dilutive, that means if its inclusion will lower the EPS figure, then the EPS figure will go down, right, if it's dilutive, and then we have to assume that the conversion of the convertible bond took place again at the beginning of the period. So we have to assume the if conversion method again, same as we have already taken for the convertible preferred stock. So that's adjustment in the denominator, that we are assuming that the bonds are converted at the beginning of the accounting period. And then in the numerator, because if you assume, if the convertible bond is dilutive, then its inclusion will lower the EPS figure, and then we assume conversion, and if this is the case, then the income available to the common shareholders will increase then by the coupon payment tax adjusted. Why tax adjusted? Because with the EPS figure we have net income included, and net income is after taxes. So therefore we have to add back then in the numerator the coupon payment times 1 minus the tax rate. And then finally we have warrants. Warrants again are call options, and the owners of the warrants have the right then to purchase common shares of the stock from the firm, and they will exercise this option, that's clear, if the warrants are in the money. That means if the average stock price is above the exercise price. So that's then with the warrants, and you have to know here, warrants are not paying any income. So therefore, if they are in the money, then they are dilutive, yeah, because then they will be exercised, and therefore they should be included then in the denominator. And the method used here is known as the treasury stock method under US GAAP, whereas IFRS does not give it a name here, but the same methodology is treasury stock method here, but the same methodology that US GAAP does use here to calculate then the number of common shares that are given then to the warrant holders. Under US GAAP, that's known then as the treasury stock method. Then in the numerator, we have no adjustments here. Why? Because warrants do not pay any income. Okay? So you see now that's a quite complicated equation here. If all our 3 potentially dilutive securities, such as convertible preferred stocks, convertible bonds, and warrants, are dilutive, then we have to include all 3 securities in the EPS equation to calculate diluted EPS. Then let's move on, right? It looks quite scaring here. Then let's move on here, how we can calculate now diluted EPS. It's the same thing as if you cook spaghetti, for example, right? Then you have to boil the water, then you have to put sail in the water, and then finally have to put the spaghetti into the boiled water. You agree with that? Then after that you will have then your plate of spaghetti. Same thing here, if you calculate diluted EPS, you have to apply now the following 3 steps. The first step is now you have to calculate the incremental effect on EPS of each potentially dilutive security. That's step 1. Then step 2, you have to rank now the securities from the most dilutive one to the least dilutive one, and based on this ranking, you have to include now security by security the potentially dilutive securities in the EPS equation, and at the point where EPS goes up, then you know that the previous EPS calculation was the diluted EPS. So that's then the application of these 3 steps. Let's take an example now. It's clear then in a real class, right? Those of you who already have taken level 2, already have taken level 1, they know about the concepts here. They should have a déjà vu, basically, of what I'm explaining here. At the others, it's clear. You have to imagine now, if you're preparing for a class, that you did the reading before you attend the class, right? And then with doing the reading first, you're already into the material, and then it's getting easier then to understand the explanations. Yeah. Now, if you didn't do the reading, that's clear. It could be a little bit complicated now for you. Yeah. But imagine you have done the reading, then that's then how the class looks, right? We are going based on the LOS. We are explaining the concepts, and with the explained concepts, then we are applying the concepts then with exam-type questions. Okay, just you have to imagine that a little bit. I think those of you who are already level 2, they see a little bit now how the class does work. Then let's take the example here. That's a diluted EPS calculation for a complex capital structure. So we have Miller Corporation had the following capital structure for the years 2009 and 2010. So we see now for the year 2009 and 2010, outstanding shares of common stock. So 1 million shares of common stocks were outstanding for both years. Then outstanding shares of convertible preferred stocks were 100,000 for both years. And we know the firm has issued as well a 9% convertible bond. 9% stands for the coupon rate, and the coupon is paid on the par value, and the par value of the convertible bond is $10 million for both years. Then we know during the year 2010, Miller Corporation paid dividends of $6 per share on its outstanding convertible preferred stocks that can be converted into 100,000 shares of the common stock. So that's information related now to the convertible preferred stock. And the 9% convertible bond can be converted into 120,000 shares of common stock, and we have an income tax rate of 35%. Okay, so let's take the question on the next slide. For the year 2010, the firm reported net income of $7 million, and now we have to calculate diluted EPS, watch out here, for the year 2010. Well, we know about the steps that we have to apply. The first step is we have to calculate first basic EPS. So let's do that. That's a quite straight calculation in this example. So basic EPS will simply be net income. So we have a net income of $7 million. And we have to deduct from it the preferred dividend payment. Well, let's quickly have a look at the preferred dividend payment. So what do we know? We know that the dividends paid are $6 per share on its outstanding convertible preferred stocks. And we know as well that the firm has in the year 2010 100,000 outstanding shares of convertible preferred stocks. So that gives then a dividend payment, you agree, of $600,000 for the preferred stocks. So 100,000 preferred shares times the dividend per share of $6 gives 600,000. So the 600,000 are deducted now from net income to come up then with the income available to the common shareholders, which is $6.4 million. This is okay with the preferred stock. So you have to understand that in the United States as well as in the United Kingdom, you have 3 sources of capital. That's debt, preferred stocks, and common stocks. And the dividend payment from preferred stocks are done from net income. That's the reason why we have to deduct from the $7 million net income then the dividend payment to the preferred stockholders of $600,000. Please note, in Switzerland and in Germany, we don't know about preferred stocks. That does not exist in Switzerland, the Swiss capital market, or in the German capital market. What we have are Vorzugsaktien, but the Vorzugsaktien that we have in Switzerland or in Germany, these are not preferred stocks. That's part of equity. Yeah? And that's not a third source of capital in addition to debt and equity. Watch out for that, right? Especially if you have a Swiss or German background here, you can get easily confused with these preferred stocks. Then this must be divided by the weighted average number of common shares outstanding. Well, let's go back here to our capital structure. So we know that at the beginning of the year 2010, the firm had 1 million shares, common shares outstanding, and the same number of common shares outstanding we have that at the end of the year 2010. So that means on average outstanding we have 1 million shares for the year 2010. Therefore over 1 million, and that gives then a basic EPS of $6.40. So basic EPS is $6.40. We don't need a calculator to determine that. Next, you remember, we have to apply now our 3 steps. The same as cooking spaghetti, yeah? You have now the 3 steps in order to be able to apply them with the accounting standards. So the first step requires now from us to calculate the incremental effect on EPS of each potentially dilutive security. So that's our first step that you have to apply. Let's do that. So I open here a new slide to show you the calculation. So calculate here the incremental effect on EPS. Incremental effect on EPS. And that's the first step. Huh? First step. Well, we have 2 potentially dilutive securities in our capital structure. First, we have the convertible preferred stock. So we know here we have the convertible preferred stock that can be converted into common shares of the stock. And as a second potentially dilutive security, we have our convertible bond. So we have 2 potentially dilutive securities in our capital structure. So let's take first the convertible preferred stock. So take the convertible preferred stock first. And now we calculate the incremental effect for our convertible preferred stock. So convertible preferred stock. Well, if the convertible preferred stock is dilutive, then we have to assume conversion at the beginning of the period, yeah, applying the if conversion method. So how many shares are given now to the preferred stockholders? Well, we know here 100,000. We know its as and converted preferred stocks can be converted into 100,000 shares of common stock. So I go back here, right? And we already know about the denominator, which is 100,000. If you like, you can multiply that then, so 100,000. If you like, you can multiply that then with 12 months over 12 months, which is the same as 100,000 using the if conversion method. And we know that the income available to common shareholders will increase then by the amount of the preferred dividend payments. So that's 600,000 in our example. So plus 600,000. You see again, we don't need a calculator. The incremental effect on EPS for our convertible preferred stock is $6. Next, we can calculate the incremental effect on EPS of our convertible bond. So next we can calculate the incremental effect on EPS of our convertible bond. Convertible bond. And that's done as follows. Again, we can start with the denominator first because we can use the if conversion method. And we know from the example that the convertible bond can be converted into 120,000 shares of the common stock. Do you see that? I mean, the information is given here, so I can include in the denominator 120,000 common shares, if you like, times 12 months over 12 months. And now we have to look at what is the increase in the numerator. That means if the convertible bond is dilutive, then its inclusion will lower the EPS figure, and then we have to assume that the conversion took place at the beginning of the period. So that means that the income available to the common shareholders will increase now by the coupon payment tax adjusted. So we know, for the coupon payment, we know that the coupon rate is 9% in our example, and we know we have a par value of $10 million. Yeah? Then what else do we know? We know that the tax rate is 35%, that allows us now to calculate the increase in income available to common shareholders. So that's the coupon rate of 9%, 0.09, times the par value of the bond of $10 million. So times $10 million. And because we are adding back the coupon payment, right, to net income, and net income is always after taxes, the coupon payment must be adjusted by the tax rate. That means times 1 minus the tax rate of 35%. I just rewrite that as follows. I just plug in the figures in the calculator in order to not rewrite all the times. Then 9% times 10 million times 1 minus the tax rate of 35%. So I take 0.09 times $10 million. And I multiply that with 0.65. Oops, I have to fill in the figures again very quickly in the calculator. So times 0.65. And that gives then $585,000. So $585,000. And we can divide that by 120,000 shares. So over 120,000 shares. And that gives then an incremental effect of the convertible bond of $4.875. Now, which of the two potentially dilutive securities is more dilutive? Is it the convertible preferred stock or is it the convertible bond? Exactly, I hear it. The bond is more dilutive than the convertible preferred stock. That's correct. So the second step is now the ranking that we have to do. And most dilutive, so if you look at the ranking here, more dilutive is the convertible bond. That's ranked number 1. Even though, if you look at the figures here, you can get a little bit confused here, because the figures, you are not supposed to take the lower of the two figures. That's not the security which is more dilutive. But the security which is more dilutive is the one which will bring most down the EPS figure, and that's the convertible bond. So the convertible bond is the most dilutive security, right? And the second rank, that means the convertible preferred stock, is less dilutive, could still be dilutive, right? But it will bring down the EPS figure less than the convertible bond. So therefore it's ranked as number 2. And now, based on this ranking, we have to calculate now our diluted EPS figure. That means you have to take first the first ranked potentially dilutive security, that's the convertible bond. And if the EPS figure goes down, we know we have calculated a basic EPS of $6.40. So if the EPS figure calculated is below $6.40, then we know that our convertible bond is dilutive. And then we can include our second potentially dilutive security. That's our convertible preferred stock, number 2, yeah, based on the ranking. And if the EPS figure still goes down after including convertible preferred stock, then we know that not only the convertible bond is dilutive, but also the convertible preferred stock is dilutive, and we're coming up then with our diluted EPS figure. So that's US GAAP, that's IFRS. Why are you supposed to know that for the CFA exams? Because the EPS figure is an important figure in order to come up then with the investment decision, whether a stock is fairly priced or not in the market. You're using the EPS to calculate the price-to-earnings ratio, for example, or you're using EPS to apply then a dividend discount model. For dividend discount model, you're multiplying then the EPS figure with the payout rate to calculate then the dividend payment. And please watch out, right? If you're doing such calculation as an analyst, you will see then that with an earnings model, a valuation model based on earnings, you're coming up closely, yeah, to the value of the stock that you can observe in the market, yeah. So the earnings are the main investment drivers of stock prices in the market. Watch out for that, right? If you apply, I don't know, a free cash flow model, for example, and you calculate the intrinsic value for common stock, then with a free cash flow model, you will have problems to come up exactly with the value of the stock that you can observe in the market. Whereas if you use a dividend discount model, but then it's also important to know here that you have to have a relationship between the dividends and the profitability of the firm. If this relationship does exist, then you can use a dividend discount model to calculate intrinsic value of stock. And then the intrinsic value calculated is very close to the stock price that you can observe then in the market. Why? Because earnings are the main investment driver. They're much more than free cash flows. Even those free cash flows are, from a theoretical point of view, much more correct figure or much more correct framework to the calculation based on cash flows. But the main investment drivers in the stock market are earnings and not cash flows. Investors are not walking around with free cash flows in their mind to come up then with an investment decision whether or not to purchase a stock. But they think in earnings. They use the price earnings multiple, for example, or a dividend discount model or residual income valuation model, which are based then on earnings. So as an analyst, you have to know how the earnings are calculated, because your information, the information you take for your calculation, this information is taken from financial statements. So you have to have an idea, or you have to know how accountants, right, how the accounting standards calculate then the EPS figure. Then it's clear, after that you have to make then adjustments, You have to take out, for example, non-reoccurring items, such as extraordinary gains or losses, or other non-reoccurring expenses and gains, in order to come up then with a core EPS figure that you can use then for valuation purposes. Then in other cases, you have to normalize the earnings over the entire business cycle, for example, to apply then these earnings in a valuation model. This is okay. So that's what you have to know then for the level 1 exam, as well as level 2 accounting, even though it's perhaps not the most interesting part perhaps of the curriculum, but analysts use then this information to calculate then the intrinsic value of the stocks. And if you don't know how the information was calculated that you used, then you would have a serious problem afterwards. I hope I was able to motivate you a little bit, Let's move on now, and let's quickly have a look at this concept here, right? And then I will stop, and I will continue then with the presentation of the program and of the CFA classes. Well, we have to do the calculation as follows. I include the first ranked potentially dilutive security. That's now in our example, the convertible bond, in order to calculate now diluted EPS. Well, diluted EPS is then calculated as follows. Diluted EPS. So that's the third step in our 3-step approach. That's the third step. So the third step that we have, calculation of diluted EPS. And first, for our calculation, we include first basic EPS. Well, we know basic EPS is net income of $7 million. We are deducting from it the preferred dividend payment of $600,000, and we are dividing that by 1 million common shares on average outstanding over the year. We agree that's basic EPS. Next, we have to include our convertible bond. Well, we know that the coupon payment after taxes is $585,000, and we have to add then to the 1 million common shares outstanding on average, the 120,000 common shares given now to the bondholders if they convert their bonds into common shares of the stock. Do you agree with this calculation so far? So I can include the figures in the calculator. I have $7 million net income. I'm deducting from that the $600,000 preferred dividend payment plus 585,000 coupon payments after taxes, and I divide that by 1,120,000 shares outstanding. That gives then an EPS figure of $6.237. And we see now the EPS figure calculated of $6.237 is lower than the basic EPS figure we have calculated of $6.40. So we know, therefore, that the convertible bond is dilutive because its inclusion has lowered the EPS figure. The next step is now to take our second ranked potentially dilutive security. So that's our convertible preferred stock. And now we have to recalculate the EPS figure. So we have to recalculate the EPS figure with our convertible preferred stock. So I take first basic EPS, it's okay for you, I'm just filling in the figures here. It's a little bit of a number crunching exercise. And we have to include as well our convertible bond, because we know this one is dilutive and therefore it must be included in order to calculate diluted EPS. And now we have to include our convertible preferred stock. Convertible preferred stocks, using the conversion method, we have 100,000 common shares given to the preferred stockholders, you agree? And the preferred dividend payment is 600,000. And now I can fill in the figures in the calculator again very quickly. So I take 7,585,000 in the numerator, and I divide that by 1,220,000. Here we go. So that gives then let's just change the marker here, $6.217. So we see now that the EPS figure went further down from $6.237 to $6.217. So we know, therefore, that not only the convertible bond is dilutive, but also the convertible preferred stock is dilutive, because its inclusion will further lower the EPS figure. And diluted EPS is $6.217. Is this okay for all of you? So if I go back here very quickly, then you see that the correct answer would be answer A. So that's a presentation here, right, of how a class looks like. So important here is just to understand that we are covering the material as follows. We are starting with the learning outcome statement. Then we will explain the concept related to the LOS. And then based on the explained concept, we are going back then to exam type questions in order to apply then the concepts. That applies for all three levels, level 1, level 2, and level 3.